Today, the Dominos, they are Afallin. Hello again, it's Martin North from Digital Finance Analytics, who I've noticed posts covering finance and problem news with a distinctively Australian flavour. So it's a Friday afternoon, and Tarric joins me once again. Hi Tarric, how are you going?
I'm not too bad, Martin. How are you?
I'm pretty good. I reckon they've devalued the minute. That's the only way I can make sense of what's going on at the moment. There's too much going on, not enough time to cover it all.
Yeah, it really did dawn on me the other day that we have reached the point now where there is so much going on in some corner of the world that I just cannot keep up with it anymore. You know, like there's always something, but something severe, something serious, and there's just too much. I mean, it's a bit like I think it was Lenin who said that there are weeks where decades happen, and there are decades where basically nothing happens, and we're unfortunately in one of the ones where there's a lot going on.
I can remember when I was a kid, right? I used to get to the start of the summer holidays and I would be bored, right, for about 5 of those 6 weeks because there was nothing happening, right? I'd love a few weeks where nothing was happening, right? Whereas you're right. It's almost impossible now to really cover everything that's going on because there are too many things all interconnected. And I don't know about you, I spent a bit of yesterday afternoon, evening watching the Boris fiasco in the UK, which was on one hand quite amusing, but also quite sad.
It is. I mean, it's a little bit of. I mean, it's kind of interesting that he got to be prime minister in the first place. I think that's a rather interesting sort of barometer for the where British politics is at. But I just think it's just emblematic of what's going on around the world. You know, he's not the only embattled leader who's made mistakes, and he won't be the last to fall either.
No, that's right. There are going to be more. And it's interesting, of course, people were drawing parallels between Trump and Boris and the fact that Boris was trying to find every way to hang on and, defy the forces of gravity, as it were. But, of course, the British have a particular way of handling this, which is quite interesting, if rather excruciating and rather long-winded.
Well, I mean, I would have rather expected them to, sort of act more swiftly to at the very least, put in a caretaker prime minister rather than allowing him to stay in office effectively as his own caretaker. But I mean, really, I mean, it just goes to show what a shambles it is. I mean, the last 48 hours before he resigned was just ridiculous. You've got resignations left, right, and centre. The party eating itself alive. And I mean, the thing I find interesting in all of this is that everybody knew what Boris Johnson was like before he became prime minister. It's not like his personality and the way he does things was a secret. He's a lot like Trump in that regard. You're very much right in that.
Yeah, absolutely. Well, you always knew what you were going to get. And it's weird, though, because, of course, he did connect quite well with a lot of, the general public. But you got to remember the last election, it's really not a very fair comparison because, of course, on the Labour side, they had an unelectable presidential candidate as well, right, which didn't really help. That distorted everything. But I've got this theory that somewhere in the depths of 10 Downing Street, there's a wind-up janitor that they can actually wheel out to basically be the acting prime minister for the next 3 months while they sort themselves out. I think that's what they need.
It's just ridiculous. I mean, like I saw some commentary before that said that he's trying to stay in office so he can have all his wedding, while he's prime minister. And I'm just like, this is just a joke. I mean, the British people are dealing with 10% inflation, or near it makes no difference, or will be shortly. And this is what we're dealing with. And I think it's just emblematic of what we're going to see throughout the world. Say for example, even in our own little corner of the world, the Philippines, for example, is experiencing severe issues with inflation, and they've elected another Marcos.
Yeah, exactly right. Although it's interesting that Albo's now come out with a new, if you like, moral platform for politicians in terms of what they can and what they can't do, which is maybe a good sign.
Yeah, I mean, look, there are certain things that I'm quite pleased about. Like, I mean, I think that's a step in the right direction. I think that, say, for example, withdrawing the government's case against some of these whistleblowers is very, very important, and I think that's a very positive step. But I mean, I would really like for Albo and the rest of his cabinet to talk about the issues, to talk about, say, for example, the rental crisis. You've got, Treasurer Chalmers, talking up today the idea of that we need that we need to look at, people's quality of life more. And it's just like, well, mate, there's all these people who were hit by the floods who are still living in caravans, who are people who are homeless. There's still people from the bushfires, which were, over 2 years ago now. But those people don't seem to rate too much of a mention at times, unfortunately.
No, it is interesting because, of course, in my surveys, I actually report on rental stress and mortgage stress, right? At the same time, I've been publishing those two sets of statistics for at least the last 2 or 3 years. And in fact, rental stress is stronger than mortgage stress at the moment. And there are more people, 2 million, in rental stress. But it's interesting that even the mainstream don't really pick up on the rental stress side of the argument, where I would argue that's probably the most emblematic area to focus on in terms of what the immediate crisis is, because a lot of those people are being forced into situations which are frankly, non-human.
Well, when it comes to the debate between homeowners and renters, inflation and interest rates, I just really wish that some people would pull out a calculator. Right now, if we're talking about pushing up towards 7% inflation, and we might already be pushing up towards that, at the moment in the current quarter, but if you look at that compared with where the RBA cash rate target, where the RBA's inflation target is, and you look at that additional cost on the consumer, on households, and then you compare that with the additional cost of interest rates rising in net terms, because obviously some people will do quite well out of rising savings rates. There's no comparison.
Yep.
They're in two completely different galaxies. Yet the focus is on rates and not on on inflation to anywhere near the degree that I think it should be.
Well, I agree with you, and I made a show yesterday actually when I spoke about the fact that for many people recession is already here. Right, the reality is that it may not be officially reported, but actually the real life experience of many people now with such high levels of inflation, food costs going up 20% and all those things. And if you overlay the rising rentals, which is huge as well, we are already in a very difficult and dark place. And by the way, it's worth just reflecting on, this 2 to 3% inflation target thing. It's interesting to ask where that came from. The short answer is it just happened a few years ago, right? And so now everybody hang their hat on it. There's no logical reason why 2 to 3% is the right target range.
No, there isn't. I mean, this is something that we discussed in our last show, talking about inflation and deflation. There isn't really any solid scientific reason, mostly because, it's all, economics in itself is a rubbery, sort of piece of academia. It's not like, like people put these things out like, these economic theories out like they're gravity, or like there's something that is sort of has some very strong empirical supporting evidence. But with economics, that doesn't really exist. We're constantly seeing theories of economics blown to pieces, before our very eyes. It's happening as we speak.
No, I agree. And the other one that I'm quite interested in, a lot of people reject the consumer sentiment surveys as not being relevant, right? Because it's not hard economics, right? Well, my argument is if you don't understand behavioral economics and you don't understand how consumer sentiment leads so many other things, then you've got no understanding of how the economy works in practice, right? I think these very, very weak sentiment surveys here in Australia, in New Zealand, in the US, in the UK, is emblematic of something very, very serious, right? And that's another reason why I would argue that most people actually would say we are probably in recession already, whatever the official statistics actually say.
Well, I've been arguing for, basically since the start of the year that we already had relative stagflation. It's all well and good for people to say, oh, but the labor market's strong. Okay, that's fine. People aren't losing their jobs, and that's a good thing. But households are going backwards at the most rapid rate in decades. If you factor out the issues with, the introduction of the GST and that sort of distortion, you're talking about going backwards at the most rapid rate in more than 20 years. And it's ridiculous. I don't know how any government can get up there and hang their hat on that. It's awful. Households need to be going forward. Although by the same token, if you look at things in real household terms per capita, we've been going down the drain for the better part of a decade.
Correct.
Just stagnation.
Yeah, absolutely. Well, real income's going nowhere. And in fact, we're in the middle of the pack if you look at absolute adjusted income growth over the last 10 years, right? We're, not as bad as some, but not very good and negative. And of course, the costs. I keep coming back to this difference between the total inflation measurement and the non-discretionary spending measurements, which are actually much higher, right? And of course, we've also got a 3-month lag between the data points, right, in Australia, which is nonsense as well, because it means that we don't actually know where we are. And I would argue that most people, when they go in the shops, they know what inflation is looking like. They feel it day in, day out, week in, week out. And it's nowhere near the 5% that the official number is. It's much, much higher.
No, well, I mean, you make an important point regarding inflation, and particularly the non-discretionary stuff. Like, if you look at certain places, particularly, you know, in some of the regions as well, like in the rental inflation has gone to the absolute moon. Even if you look at the capitals, you know, according to SQM, asking rents are up over 16% over the last 12 months. That is a truly astounding figure, considering the fact that the borders were closed for much of that time. Yet, the ABS says that rents more broadly are only up 1%. Now, I realize that they are measuring different things. SQM is measuring asking rents. The ABS is measuring rents as a whole. But that suggests that there's a whole bunch of rental price pressures going to be coming through the CPI in the next couple of years. But what it also says to me is that people getting even these award rate pay rises of 4.6, 5.1% are still rapidly falling behind this cost of living that isn't really being measured.
Absolutely. And the same in the US, by the way. The rental numbers in the US are 6 months lagged in terms of how it goes into the CPI number. And the problem is, of course, that not every rent gets adjusted up every week or every month, right? So you have a rent reset every 6 months or 12 months or whatever it is. So there will be some people on lower rents, but every time it's reset, it then goes a lot higher. That's the number that's actually, of course, the SQM data is pointing to, which is that the new rents are way higher. And in my surveys, I see a lot of people who are looking now for cheaper places to rent because they can't afford to rent where they had lived previously. And that's creating a whole lot of social disruption, as well as, of course, going into perhaps lesser quality housing, or indeed in some cases, even some people saying, well, it'll be the car next.
Yeah, and it's something that really just frankly needs addressing. I mean, we are a nation that spends billions of dollars on a policy that is ostensibly designed or meant to provide rental stock, but it doesn't. We just spend billions of dollars because we spend billions of dollars for basically no reason. Yeah. And it's rather ridiculous. You know, people say to me, oh, but it provides rental stock. Well, not really, because a house is a house is a house, whether someone's living in it as an owner-occupier or whether someone's renting it. When you buy an owner-occupier home and turn it into a rental property, you're not magically creating another house. It's just shifting the numbers on the ledger.
Yeah, I agree with that. And before we get into your slides, I'll make one last point. There was a very important Ahuri report that came out just a couple of days ago looking at first-time buyer support. And they argued, as I've been arguing for a long, long time, that all this first-time buyer demand, pull forward, drag stuff that has been there has actually done nothing to help first-time buyers. It's helped other people elsewhere. It's lifted prices, and it's actually made it harder for people to get into the marketplace. So yet another validation of the fact that we're spending billions of dollars of money in the wrong area, doing the wrong things to try and solve the housing problem. Government's a part of the problem here, not part of the solution.
I don't really have anything to add to that. I completely concur. It's just a completely broken system.
Well, talking about broken systems, let's have a look at this wonderful chart, right? Which is a wonderful place to start the charts today.
Yes. Well, as usual, people, the charts will be available at avidcom.substack.com. And without further ado, we'll get into them. Now, I thought we'd start this week by covering a question that we had in last week's comments. People were asking, why do I focus so heavily on the Sydney and Melbourne property markets rather than, the fact that the other half of the country obviously exists? And that's because Sydney and Melbourne lead the country. The properties that are in the top quartile lead the rest of the market, both up and down. This chart from CBA that I've got here just shows how basically you can see that the top end of the market falls first, and it also rises first and rises more significantly. And now that we've got that top quartile falling, those prices are actually falling more rapidly than they were during the COVID panic, which I think is quite interesting.
Absolutely. And of course, the other point to make is Sydney and Melbourne is a lion's share of the total property market. If you look at the total number of transactions, the total footprint of property, all those things. So as well as the fact that those markets lead the way and the top part of those markets go first, they also are where the centre of gravity is. So, in other words, if Sydney and Melbourne fall off the perch, the other sectors and other places won't be able to maintain the same momentum. So it makes perfect sense to start there. And this is a really scary point about just how much property prices are falling. I made a show the other day just showing again, vendors are having to drop their asking price considerably now, 10 to 15% in some cases, just to get a look in. That's within 2 months of rates starting to basically be cut. So, it's ain't seen nothing yet, I suppose.
Indeed, and we'll get to that in the next slide. This is from CoreLogic, which was published this morning by the Sydney Morning Herald, and it basically just shows the parts of New South Wales where the homes are falling the fastest on a quarterly basis. Now, this is the quarter to the end of June. Now, I talked about the subject, the suburb, I should say, of Frenchs Forest in Sydney, on Sydney's northern beaches, which is part of the Warringah area, or at least part of it is anyway. And it just goes to show that the data I provided from SQM was accurate, because it's now falling at one of the fastest rates in New South Wales, falling between 7.2 and 6.5%, depending on which part of the area you're talking about. Now, that's really significant falls in just one quarter. I mean, during the entirety of the 2017 to 2019 price falls, you talked about price falls in the Sydney areas of about 15%. So this is very, very, very swift relative to that. I mean, you wouldn't want to chart this against the US housing crash, and put it that way.
I guess the point to make, Tarric, is that we had a massive run-up, right? More than 20% in some of these areas. So we're now sort of falling from those peaks, but the rate of fall is very significant. And remember that run-up was completely artificially created. It was created by very free government money and ultra-low interest rates. That's now being all unscrambled. So it's no surprise that prices are starting to fall. And the rate of acceleration is increasing. So the chances are that over the next 2 or 3 years, we're going to see this momentum continue to go into negative territory, particularly as the Reserve Bank lift rates higher. The question will become, at what point do they then actually stop lifting rates and turn turtle? And that, of course, now becomes the big critical question. To what extent are they actually looking at house prices? They claim not to influence house prices directly. Well, they certainly do indirectly. Will they actually want to try and alleviate some of these falls, or will they say, collateral damage, we still have to fight inflation?
I think for the immediately foreseeable future, I think they're going to keep raising rates, because the labour market is strong. They don't really have any excuse to stop being hawkish at this point. Now, obviously, if the US gets smashed into a recession and the markets all tank into oblivion, then perhaps it's going to be another story. But the question remains, what happens to inflation over that time? And just on the point of the housing market more broadly, I did a bit of an analysis recently. It's in an article last week. I'll send it to you, and I'll get you to put it in the description. But basically, I charted the housing prices in New Zealand and Australia pre and post rate hike for the first 2 months, because at that point that was all the data that I had. And in New Zealand, on a national level, prices continue to rise after rates had risen. In Australia, in particularly in Sydney and Melbourne, prices were falling already prior to rates rising. So I think that's a really, really key thing going forward, because yes, New Zealand is the bellwether, and I'm going to get to that again shortly, but Australia was in a weaker position to begin with.
Yeah, and some of that could be just the size of the mortgages, or maybe the other economic drivers are different here compared with New Zealand. And of course, New Zealand is further ahead, right? So further down the curve.
Yeah, exactly. I mean, this is the chart that I showed last week, and it basically just shows that this is what went from when prices peaked. Now, prices didn't peak immediately. Prices actually peaked afterwards. So that's what I think is rather interesting here. And Australia was already in a weaker position, so it's going to be really interesting to see how price falls in Australia accelerate, to see if they match these falls that we're seeing in some of the larger Kiwi cities.
Yeah, absolutely. And I suspect that we will see somewhat similar stories. But what I'm noticing, and again, you have to look at this on a more granular basis, there are areas now across Sydney, for example, where apartment prices are moving down very smartly already. right? And of course, aggregate numbers don't necessarily tell you about the dynamics in individual areas. And I'm also now seeing for the first time some changes in regional areas, because regional areas ran up dramatically too. That's looking as though that's reversing too. So I think we're going to see significant changes over the next little while across Australia. And even in Adelaide, Adelaide, which was trumpeted until very recently as well, this market is still going up. Well, I'm looking at data now that's showing that even in Adelaide, some house prices are beginning to slide back. So I think things are going to move quick.
Yeah, I concur. And just on the topic of rates, as we were discussing before, and whether what will sort of happen with the RBA in that regard. Now, if we use New Zealand once again as the bellwether for the impact of rising rates and falling housing prices, now you're talking about some markets that have fallen almost 15%, in a little over 6 months. So you're talking about like one of the swiftest modern housing crashes in that regard. Normally they take a couple of years. If prices keep falling at the rate they're falling, you're going to be talking about a US housing crash crammed into about a year in some of these areas. Yet, despite prices falling, despite the Kiwi economy decelerating, it contracted by 0.2% in the first quarter, unemployment isn't rising. So even though the froth and the heat is being taken out of the Kiwi economy, I should say, it's not having a material impact on the labour market yet. And New Zealand has one of its lowest unemployment rates in decades, perhaps ever. I'm not sure. I haven't gone back and looked through the entire data series, only the more modern stuff. But that raises an interesting point when it comes to the RBA and interest rates. Because if the labour market is going to remain strong, even as they take the heat out of the economy, if the labour market remains, let's not call it strong, let's call it decent. If it just remains sort of okay, that's enough for them to keep raising rates. If inflation remains strong, they don't really have any excuse in that regard.
No, and I guess the question is, well, are they measuring unemployment right? So we know, of course, there's a very specific definition of unemployed, which may not actually tell you the full story. The other point is that, again, in my surveys, I'm seeing a lot of people now with multiple jobs, but multiple sort of fragmented jobs to try and actually earn a bit more money, to try and actually pay for all that inflated cost of living and inflated mortgages. And so that could also put a bit of a flaw on the definition of unemployed and unemployment, right? That may not actually tell you the real story. And we also know, of course, that other people over 55 particularly have elected to step out of the employment market completely. So they're not counted in any of the numbers, right? That's something else that's just worth thinking about in terms of some of the dynamics here. So maybe those numbers, the employment numbers, are artificially low. But as you say, the central banks will say, well, we can go on lifting rates because we're not killing the employment.
Exactly. I mean, it doesn't matter whether they're correct or not from their perspective. I mean, it obviously matters, but in terms of their decision making, whether they're correct or whether they're not, that's the defining factor. The defining factor is going to be the unemployment rate. And currently the labour market in Australia is very, very strong. And it's taken. You look at things like job ads, you look at things like job openings, all these other indices provided by the ABS. I mean, yes, I'm naturally, I know there's going to be a few comments saying there's all sorts of issues with those, and I know, and I'm aware of that. But unfortunately, you've just got to take the data at face value. It's at some point when there isn't another alternative measure that has been provided. But that basically says to the RBA, have at it. Another 0.5% next month, 0.5% after that. No worries, we can do it.
And of course, employment is exactly going the same way in the UK and in the US. The number of job openings in both those places are as high as they've ever been, and the unemployment rate is also reported, to be relatively low. So there's something weird going on in the way that the measurements are flowing through, and whether that's a fallout from part-time work or whatever it is, but there's something different now from where we were, a few years ago. And I think that maybe we should be a little bit cautious about really saying this is as good news as it may appear superficially. Well,
I mean, even if you take it at face value, and then you just sort of look at it within the broader context of what's going on, it's good news, but there's a rather large but attached to the end of it, because it's all well and good to say, oh, people are employed, and that's fantastic. But if you look at wages growth, you look at real wages growth, particularly if we're heading towards the 7% inflation that the Treasurer and the RBA governor are talking about, people are going backwards at 1 million miles an hour. So it's not really good news when you put it into a broader context in that regard.
No, I agree with that. And, the wages story is still very weak in real terms going backwards. And again, if you look at the distribution of pay rises, there are some areas where, if you're in IT, for example, you're probably doing quite well. But if you're in the healthcare sector, or if you're in, the old age care sector, there's very little good news. Okay, there might have been a slight uplift from 1 July, but in real terms, you're still way off where you need to be. The working poor, and the concept of the working poor, in other words, people working every hour that God gives, with still not enough coming in at the end of the day to cover the cost of living, is frighteningly where I think we're at now for many people.
Yeah, unfortunately so. And unfortunately, as inflation continues to rise and wages growth remains, insufficient, shall we say, that unfortunately those ranks are only going to grow larger. I mean, we've seen that recently with some of these videos emerging from these, kilometre-long lines for food banks in Victoria, for example.
Yeah, no, the food bank story was pretty amazing. And of course, some of the people have said, well, they're sitting in quite nicely appointed vehicles waiting for the food bank. But, I suppose you can draw all sorts of conclusions from that. But the truth is that food banks have never been busier. It's true in the UK, it's true in the US, it's true in New Zealand, it's true in Australia. Again, that tells you something very important.
Yeah, because there's no financial stress, right?
Yep.
I mean, that's
Exactly.
that's what I hear. Yeah, everything's great. Well, this is the other side of the coin, isn't it? This chart from Morgan Stanley basically shows that in nominal terms, so obviously this isn't adjusted for inflation, Australian retail sales are at levels consistent with the trend out to 2038. Now, this is the another side of the coin that the RBA really needs to sort of keep a bit of an eye on, because this level of activity is basically consistent with there continuing to be upward pressure on inflation. And since this particular graph was released, there's been more data to show that retail sales have risen even more. So it's really quite interesting in that regard. How the two-speed or K-shaped economy of Australia is emerging, where the wealthy and the affluent feel more than happy to keep on spending, especially after they've had their spending curtailed by various restrictions over the last 2 years, whereas other people are, at the other end of the spectrum, are down the food bank.
Absolutely. And it's also just bearing in mind, as you said, this isn't adjusted for inflation, right? So the fact is that you're going to see bigger volumes coming through in terms of turnover with higher inflation.
No,
right?
Of course. Yeah.
And so that's something else we should bear in mind when they look at these numbers, right? You would expect to see retail sales growing quite strongly because by definition it's inflated. But the distribution point is absolutely critical. And there was a very important piece of research done from the UK, from the Resolution Council, showing that the bottom income groups, the real inflation was significantly higher relative to other sectors. They were spending a lot more on the necessities, which of course are higher inflation as well. And their ability to spend in other areas had gone through the floor, whereas actually more affluent people were sitting there with significant buffers, significant savings, and were still spending freely, starting to fly and going on holiday and those sorts of things. So you've really got this bifurcation between those two ends of the spectrum. And again, a lot of the data sets that come out don't really get any close to trying to understand those differences.
No, they don't. And that's the problem for central banks, not just for the RBA, but for central banks globally going forward. Because, if the affluent do continue to spend, or even if the middle class continue to spend or turn to credit, as we've seen in the US with record consumer credit growth, that could continue to support, the inflationary story for longer than is generally expected, particularly if the labour market does remain, shall we say, adequately strong.
Absolutely. Well, the credit story is very interesting because, of course, we'll see a bit later that some of the momentum from housing is easing now in the US. But interestingly, personal credit in the US is very strong, and it's a little bit stronger here in Australia than what. Plus, of course, we have the very strong use of buy now, pay later. So those really aren't in any of the formal statistics separately.
Yeah.
They should.
Well, therein lies the problem, especially because, in the US, the credit statistics are fantastic, but with the proliferation here in Australia in particular of buy now, pay later, it's a lot more opaque.
Correct.
Than the US.
And some would say that's a bit deliberate, but I wouldn't possibly say that.
No, we wouldn't want to get ourselves in trouble again, would we? Well, this is, but in China, COVID zero still not working. COVID cases are back on the rise. We've, been talking about sending parts of Shanghai back into lockdown, and, it's Groundhog Day again.
Yeah, and I'll just make the point, Tarric, of course, we've got the same issue here, right? So the number of cases in Australia are rising significantly, and there is now calls for more of a clampdown and all those things. I mean, they made some announcements yesterday about the fourth dose and what have you. We seem to have sort of almost ignored the fact that COVID is still around and everything's fine. Well, it may not be, and of course, the latest variants are actually perhaps a little bit more easier to spread, and they also have more severe symptoms, particularly down, in the lungs. So watch this space. It's not over yet.
Well, we're just going to have to wait and see in that regard. I mean, you've got some fairly notable people, even considering, going back into lockdown. I mean, I think it'd be a politically untenable move at this point, considering the way that public opinion has evolved. But I mean, it's still early days in that regard. And I mean, when it comes to the politicians, you just don't know what's going to happen in that regard.
But I would make the point that China the other week said, we'll be still doing this next year and beyond, right?
Well, they said they were basically, they said before they retracted it, they were going to do it for the next 5 years. So,
yes.
Come back and look at Australia in 5 years. If China keeps this up, it's not going to be fun times.
I agree.
Now, despite the stimulus taps are on, everything's great, etc. in China, the rates payable on debts for small businesses who are struggling badly in many cases as a result of COVID zero, being in and out of lockdown. I mean, it must just be absolutely awful. There's no JobKeeper, there's no, government support payments like that raining from the sky. And then they're basically being asked to pay, in some cases, double the interest rates that they were at the start of COVID.
Yeah, very interesting. And it's interesting, of course, that China is talking about more stimulatory measures, and they also reduced the capital buffers that the banks actually had to hold to try and actually reduce interest rates. It's interesting that despite that, these rates are going up and are actually much higher, not just a little bit, much higher. So that's very concerning. Many small businesses, of course, up there are also being crunched because they're unable to trade the way that they used to, and cost of sourcing materials, the same old story. So it's not looking good for the small businesses.
No, and it's not really looking good for large, for Chinese local government, because they are the vehicle by which growth is driven. They borrow the money, they build the infrastructure, and they basically drive, the traditional engine of Chinese growth. Yet many of them now are up the creek without a paddle when it comes with debts. I mean, it reached the point toward the end of last year where now I know this sounds crazy, but it's absolutely true. They create a company, a local government financing vehicle. They then sell their own land to this company after this company borrows money from the bond market, backed by the local government's credit, in order to fund basically their revenues and their day-to-day expenses, because on average, about 40% of local government revenue comes from land sales. But with all the property developers up the creek, that those land sales aren't happening in the same volume, and in some cases at the same prices. So they're seeing big revenue shortfalls. And part of me wonders if a rather substantial portion of these new local government bonds that they're talking about front-loading into this year is going to be used to support them, is going to be used to help prop them up.
Oh, that would never happen, would it?
Well, I mean, China's data and all of the various things like this is as clear as mud. So, it wouldn't surprise me in the slightest.
No, what goes around comes around, I think is probably the way I'd sum it up.
Indeed. Now, this is a good one from China Beige Book, who's one of my favorite data providers for all things China. And it basically just shows that despite all the hype, despite all the various, commentary that the stimulus is coming right now, or is already here, the Chinese construction sector continues to suffer, and it's not getting better. And I think it's also important to keep in mind that this is what the chart looks like when the level of fixed asset investment, so it's like infrastructure, etc., is still growing at 6.2% year on year, according to the official numbers. So if we take that at face value, which is Chinese data. If we take that at face value, that means that the property sector is basically getting smashed into oblivion. So I think that's a really, really interesting data point, particularly considering Australia's reliance on a strong Chinese construction sector.
Yeah, the only good news, I suppose, is that they're going to be building lots of LNG plants so that they can actually import more LNG, right? So there's going to be a lot of construction in that particular part, but the rest of it, it's good night Vienna.
Pretty much, pretty much. Well, they're borrowing more money. That's the one thing that's going in the right direction or the wrong direction, depending on your perspective. Now, this is, I think, one of the really interesting points about the US labour market relative to, say, Australia. In Australia, there are significantly more people employed today than there was before COVID. In the US, they still haven't recovered all the jobs that they lost during COVID, and nor have they got anywhere near the pre-pandemic trend. Now, interestingly enough, a lot of that is missing female participants within the labour force, which is really quite interesting because that's the opposite of what's currently happening in Australia and elsewhere in the world. So, there are obviously some domestic US factors in that regard, but the tighter the labour market is, and the fewer people who choose to come back to the labour market, the longer wage inflation is going to be an issue. Wage inflation recently hit a multi-decade high in the US, according to the Fed's wage tracker index. So it's going to be very interesting to see in that regard how the US plays out, given its rather different, shall we say, issues with its labour market.
Yeah, no, it is, and it's quite interesting. Also, if you look at some of the regional trends in the US, right, because some of these trends do vary quite considerably, East Coast, West Coast, and rural versus city. But there is something weird going on, and you make comparisons between here and there. The dynamics do seem quite different.
Yeah, they really are, and I think that's going to be something that's going to be, I think, a defining factor for the US going forward, because they are seeing the wage growth that we aren't.
Yep.
That some other developed countries aren't seeing in the same way. I mean, they're talking north of 5% wage growth. Here in Australia, we can only dream of that.
Exactly.
Well, it's the RBA's nightmare, but it's our dream.
Yeah, well, the RBA doesn't want you to have a big pay rise.
No, and I'm really taking it personally. Okay. This chart from Nordea, I think, is quite interesting. Now, because it does show US unemployment continuing to rise basically into the end of 2023 based on various different surveys and modelling that they do. And I generally quite like their modelling in that regard. And basically, it shows that US unemployment is going to rise to about 4.5%, in the next sort of 12 to 18 months. But I think that is a really interesting thing, because rising to 4.5%, well, it's not that big of a deal. 4.5% unemployment for the US is, still well below the sort of multi-decade average, and it's not really a bad place to be in the grand scheme of things. So, the Fed having the excuse of a rapidly deteriorating labour market, at least if this survey data, proves to be prescient, isn't potentially going to materialise anytime soon.
No, that's very interesting. And of course, the Fed has said, well, there is still a way that we can engineer a soft landing, right? So in other words, we don't have to go into recession. There are others, of course, now saying, well, they're probably in recession, actually. They just don't see it yet. And the Atlanta Fed number was negative GDP, right? So when the latest forecast. So that's sort of the nowcast. So we'll see how that pans out. So nobody quite knows where they are, right? And how much close to recession they need to get before things start really showing up, because some of the other indicators are a bit stronger. And that's part of the problem here, that the indicators are pointing a number of different directions. But if it's true that they can actually lift unemployment a little bit and still actually not feel as though they're in recession, that allows them to take those rates a bit higher too.
Yeah, that's the sort of case that I'm really looking at the moment, because there are those factors that we talked about with the previous slide that are supporting employment in that regard. Now, I don't doubt that, given sufficient time and sufficient rate rises and the market tanking into oblivion, that eventually, obviously, the labour market's going to get hit, and it's going to get hit hard. But it's a question of timing, of how long that particular scenario is going to take to play out. And obviously, you've still got the backdrop of 8.6% inflation. I feel like sometimes, with the market, it's just rushing from one side of the ship to the other. A couple of weeks ago when Lagarde and all that were hawking up on inflation, talking about, we have to beat this as our number one priority. Now all of a sudden, everyone's run to the other side of the ship and gone, oh, no, we don't need to worry about yields and rates anymore. Inflation is going to be killed by this recession. But I mean, let's say that I think there is a fairly reasonable chance that with a sufficiently bad recession, you could kill inflation at least for a time.
Yep.
But
consequences,
yes,
right? And it's interesting. Ken Henry was interviewed on the ABC. I don't know whether you saw it, but I think it was on 7:30, and that basically he was trying to get him to decide: is inflation or recession, which is worse, right? which would you prefer?
Well, my theory in all of this is that that a recession is the preferable option over letting inflation run forever and ever, because it has an end point. There is a point where, as we've seen recently with dropping commodity prices, potentially signaling something to this effect if and when it does occur. I think if you crunch things badly enough, eventually the liquidity in the commodity market will get smashed. People won't want to put on all these big trades, hoping for these huge roars in commodity prices, and eventually things will get crunched hard enough to drop inflation for a time. So I think that at least with targeting inflation, you have an end point. If you let inflation run, you abrogate your responsibility completely. You let inflation expectations go to the moon because you're no longer taking the issue seriously. There's no end. There's no end to that. There's no end game. It just keeps going and going and going until something else blows up, and you end up with either an inflationary crisis, or you end up with something blowing up so badly that you end up with deflationary depression. So this way, you at least get some sort of controlled descent rather than just rapidly falling out of orbit and then smashing back into the earth.
Yeah, well, I suppose the implication of that is that rates will be lifted and continue to be lifted, and probably for longer and higher than some people are saying. And so the markets are now saying, well, maybe they'll lift and then come back. But if in fact the real answer is they have to crush inflation because the long-term consequences of not crushing inflation are too severe, and if you risk a bit of deflation and other things and recessions and things as a result of that, as you say, you can pull yourself back perhaps from the other way. Whereas if you don't kill inflation and it gets embedded, then that's a multi-year complex problem. And if you go back to the 70s and 80s, it took a lot of pain to try and solve it.
Exactly. To me, it's about options. It's targeting inflation and potentially causing a recession or whatever. It gives a central bank, it gives a government options, because eventually you will crunch inflation hard enough for to at least buy some time, to at least buy some scope to stimulate the economy in the right way to get it moving forward. But if you just let inflation run, you let business profitability get destroyed by rising costs. You let households get smashed to the point where they just go, no more, I'm not spending anymore. I just need to just buy what I need to buy, and all this other stuff is just too much. I just can't take it anymore. I just think that it gives them options. And at the end of the day, the thing with politicians is they need to be seen as doing something. It's a similar thing with central banks. They need to be seen as having capabilities to affect outcomes. If you just let inflation run and throw your hands up in the air, you're basically just admitting that you have no control. And you can't let everyone know the emperor has no clothes.
Right, but that also says that actually it's not just economics, it's politics, right? Actually, politics will fundamentally determine what they choose to do.
Yeah, well, everything is political at the end of the day in that regard. There are certain things that we could do tomorrow that would benefit everyone, but they're politically unviable.
Yep, indeed.
This is a good one. US home listings are surging, rather significantly year on year, and obviously this is from a low base, so that does need to be taken into account. But I think that the only way is up in that regard.
Yeah, and as I said a little while ago, there's signs that the US housing market is beginning to turn over now. The average fixed rate's now close at 6%, so that's a lot higher than it was. It's come back a little bit from where it was, by the way. And my latest reading is that in some markets, prices have already started to slide quite a lot at the time when listings are rising. Now, of course, rising listings is often correlated to falling house prices. It's sort of, supply, demand, et cetera, et cetera. So very interesting to watch how that plays out. But as you say, they did start from a low base. So, and they have had a run up in recent times.
Yeah, it's going to be interesting to watch because, as someone mentioned on Twitter before, we're seeing all these loans written by non-bank lenders, and they had issues with that before. Obviously, credit standards are a lot tighter now. They're a lot tighter than Australia's anyway.
Fingers crossed.
Yes. Well, they are on paper.
Yes.
So, but it's going to be interesting to see.
Yeah, it will be. Absolutely.
Global real estate PMI.
Yep.
Really speaks for itself.
Says it all, doesn't it, really, Tarric?
It does. It's good. It's been absolutely poleaxed.
Yeah.
This is worse than the immediate aftermath of the global financial crisis. And admittedly, part of this is no doubt China, but it just goes to show, they jammed all this liquidity, all this stimulus into the system, and it was unsustainable.
Yeah. Well, I can tell you here locally in my surveys, real estate agents are much less confident and their profitability is going through the floor. And of course, the construction sector here in Australia is also, under the gun. A lot more bad news there. I think we already saw another Victorian builder fail this week. We're going to see a lot more of that. So it doesn't surprise me that actually, the whole thing's on the downward path. We're in a profitless boom for construction. We're in a real estate sector that's had a huge run for the last year, 18 months, surprising run, beginning to turn the other way now. So watch what happens with those particular metrics here in Australia. It'll be quite interesting to see.
Indeed, and I think it's interesting as well, just looking at the construction sector here in Australia, because there was a paper put out by the RBA towards the end of 2019 that talked about the construction bust. That basically we'd had this huge run up in construction, apartments, etc., and that basically it was unsustainable. That it was going to start to come down, and that up to they were talking about 100, potentially over 100,000 jobs being lost in the construction sector. It was a big deal.
Yep.
And this isn't just someone going in the paper and then just spouting some crap. This is literally the RBA warning the government, warning the country that this is what's ahead. And then we pumped the construction sector to the moon. Yep. That was already in a very, very strong and elevated position. So in a way, it's not really that surprising that there needs to be a reckoning, despite the fact that there are already a lot of vested interests out in the media in the last couple of days who are very much saying that the government needs to step in again.
Yeah. Well, that's right. Like some of the building sector saying RBA needs to stop because otherwise they'll crush the construction sector. Well, wait, hey, how does that work?
Yeah, well, exactly. We've reached a point now. At the end of the day, it's not the RBA's job to make sure that the construction sector is profitable. It's not that. That's not the, there's not a mandate on their website that says must make billionaire developers lots of money. It's about inflation and it's about employment. And I don't know. At the end of the day, it's a boom bust industry, construction. It always has been.
Absolutely. Yeah.
And that's not going to change.
No, but of course, what happened is that people got really enthusiastic about all of these government stimulus packages and homeland packages and those sorts of things. But the industry should have understood that fixed price contracts are quite risky.
Indeed, and I think that we've just reached a really strange point here in Australia where people just want handouts. There's always been that sort of undertone within certain aspects of society, certain industries. But I just feel like, rather than just dealing with it, just, copying it on the chin, getting on with it, as many builders and people in the construction sector have done time and time again over the years, and I have builders in my family, and they know that there are sometimes there are lean times, and you prepare for those.
Yeah.
But unfortunately, we've had a government and a narrative that just suggests that the good times will roll forever.
Yes, and the assumption is that the government will always find a way to help people. It's a bit like the debate about individual households who've got big mortgages and signed up over the last year or so. And of course, they now turn around and say, well, I blame the Reserve Bank for telling me that rates wouldn't go up until 2024. That was the basis on which I made my decision. But actually, you signed the bit of paper, right? Not the Reserve Bank. So ultimately, it's interesting to debate, where does the buck actually stop, right? And there is a tendency, in retrospect, to say, it wasn't my fault. It was whoever it was, RBA, the bank or whatever. Personal responsibility actually is part of the picture, it seems to me.
I thoroughly agree. I mean, I have empathy for the position that some people will put in. I don't disagree that it was challenging. When you see the market running away from you, when you've been presented with an opportunity to get in, at what you think is a reasonable cost on the day, and then you make that decision. But as you say, when you sign a piece of paper, particularly a piece of paper that basically says you are attached to this forever, for the next 30 years,
yes.
Which is, functionally forever, and come hell or high water, this thing is going to, basically, be a millstone around your neck, because that's what it is. I mean, you are going to have to pay this. There's no jingle mail here. You are going to have to pay that loan, no matter what happens. And I feel like we need more financial education in that, or at the very least, something needs to be, I don't know. Like I talk to people, I talk to mortgage brokers, people, sort of telling people, look, the bank will give you the loan, but I don't think you should do this.
Yep.
And people who just go, no, yep. I'm doing it anyway. Yep. Like people say it's about financial education. I think in some cases that's true, but in other cases, I think it's just willful, no, that's not going to happen. She'll be right. The government will bail me out. They won't let that happen. I mean, you had High Rise Harry saying, the government can't let prices fall today in the Australian.
Exactly. Well, there are vested interests, of course, just wanting to get the government to support this or that or the other. But, the truth is that many people, when they make that decision to buy that property, they don't go through a robust evaluation process on their own behalf, right? That what they do is they say, well, the bank says I can get the money, right? And I see property prices rising, and the RBA is saying no rate rises until 2024. Right, that's sufficient, right? But I always say to people, run the counterfactual. What happens if, rates go up 2 or 3%? How would you cope, right? And it amazes me still that a lot of people never actually go through that part of the thinking process, right? Because they've always got the positive attitude and, the expectation. And then they accuse me of being negative, right? No, I'm not being negative. I'm just trying to say, get a balanced view here and make sure you've got a plan B if, plan A doesn't work the way you expect.
No, exactly. I mean, one of the things I've always thought was interesting is I play with these mortgage calculators, and, I see, I do different scenarios. I'm like, okay, this is a family's expenses. This is a family's income. This is their situation. This is their dependents, etc. How much can they borrow? Right. And you are talking literally in a lot of cases that you go and, people can feel free to look at the various bank mortgage calculators themselves. In some cases, they let you borrow straight into mortgage stress, into not your cash flow mortgage stress, into you are spending more than 30% of your income
absolutely
on the loan, which is nuts. Okay, you might be able to afford that today, and you might be able to afford that in perpetuity. But can you be able to afford it when that 30, 33, 34, 37% of your mortgage, 37% of your gross income becomes 50 when the rates have risen? It's just crazy to me.
Well, the old 30-year rule, it used to be 20 years and 25 years. Now it's 30 years. So that's the first thing that has gone out, right? And now people are talking about 50-year mortgages. Well, that will just extend the interest payment period much longer. You might reduce the repayments slightly per month. But the point is the sensitivities that are now built in are huge. And I really just don't think that people get it. And I'm frustrated by that, because I spent many years trying to help people understand a bit more about this whole situation. And the calculators, to my mind, don't do a good job of helping people to think about the counterfactual, and they just want to sell a mortgage. And that's the point. These calculators, they're sales tools. That's the point to remember.
Well, it's interesting, that just say for example, you've been mentioning for a while the loans that have been written at more than 6 times household income.
Yep.
I mean, if you talk about rates that even let's just say a relatively pedestrian rate, let's say like 2%. How many people who got one of these cheapy loans on the cusp of mortgage stress, on a 6x income loan, how many of them are going to be in a positive place when rates hit 2%? When the cash rate hits 2%, potentially on its way to 3.5%. Not many.
Exactly right. 1% higher is a 15% monthly repayment increase, right? That's roughly the rule of thumb. So it's a big amount. And unfortunately, I know from my surveys, some people are now getting really, really nervous and really concerned. But it's very hard to sort of retrofit a different set of behaviours when your financial position fundamentally changes, unless you really take hard decisions. And some of those hard decisions are, for example, taking kids out of private school, or giving up on dental treatment, or those sorts of things. I mean, those are the sorts of things that people are now having to do just to get by. And that's before the full force of the rate rises come through. And, I keep talking about the third of people who are really well off and are doing fine, and the other third down the bottom who've got no savings and live paycheck to paycheck. But the people in the middle, they're the ones being pulled down towards that lower reach. They're the ones that are really, caught now, some of those marginal borrowers. And, some accountability has to go to the RBA, some accountability to the banks, but there is also personal accountability in all of this too. And that's the complexity that I guess we've got to try and deal with.
Yeah, and I think that's fair. I think there needs to be, a sort of, a fair-minded assessment of how this is all played out. But I think you make an interesting point in terms of just the cost of living, because as the cost of living rises significantly faster than wages, and is expected to for basically, most of the forward estimates, that for that entire period, people's ability to service their loans in relative terms continues to degrade, and so too does their ability to spend. So, it's not a pretty picture in that regard, and it's only going to get harder.
Yeah, absolutely. And that's the point I keep saying to people: prepare for higher rates now. So start planning now, build a cash flow now, understand what your finances look like, start making those decisions now. Don't just wait and hope that somehow magically the RBA won't lift rates. That's not going to be a plan, because hope is not a strategy.
No. And let's say, for argument's sake, that the likes of, say, Nomura are right. That there's going to be a recession here in Australia within the next 12 months. That will, in some ways, either get the RBA to pause or get them to talk about, cutting interest rates. Let's just say, for example, that that's true. That is correct. Now, if that were to come to pass, there's a lot of commentary that says, isn't this going to be great? Because we're going to be able to get bigger loans again, because the repayments are going to go down, et cetera, et cetera. But you have to deal with the bloody recession,
Correct.
and a recession of indeterminate length and indeterminate severity. So maybe it's just a good idea to sort of just have a bit of a broad overview of what's what in that regard.
Absolutely. And just remember, the last 18 months was atypical of what happened, right? Because we had the ultra low interest rates, all the government stimulus and everything else. And we probably won't see property prices anything like so strong for a long time into the future. So you can't even assume that I'll hold on and I'll wait for the value to recover. It may not. So you've got to assume that values might not recover, that the cash flow pressures will remain, and interest rates will be higher, at least for a period of time, before they might ease back slightly. So lay those plans now. Don't just sort of sit there and hope. And it's going to be painful for many people, unfortunately.
Indeed. If the future is inflationary, if these types of rates that we're seeing now, so say today, 1.35%, if this is going to be something that's looked upon in a couple of years' time as an idealized, oh my God, it was so much easier then, in terms of the way where rates are going, because the truth is we don't know what's going to happen with rates. It's all well and good to say that there's going to be a recession and that's going to hit inflation, it's going to hit interest rates, etc. But there's no guarantee that inflation after that isn't going to roar back into life again on any number of domestic or geopolitical issues. We just don't know. That if the current issues with Russia and Ukraine continue into the future, and Russian oil production is permanently impacted, that could mean permanently higher energy prices. So, say hypothetically, energy prices get smashed in this potential recession that we're talking about, and then they just roar straight back again, and then you've got an inflationary problem all over again. So, there's no guarantee that we're going to go back to the way things were before.
Absolutely. I always say expect the unexpected, right? I think even so, that's a very good motto for where we are now.
Yeah, well, or prepare for it, perhaps.
Yeah, exactly right.
Okay, US manufacturing capacity is returning to the States. The number of manufacturing facilities being constructed has soared by 116%. Now, admittedly, as with some of the other things we discussed today, that is from a low base, but it just goes to show how American businesses are adjusting to the new geopolitical times. And I think that could be quite key going forward, because the less US investment that's going on in China, the less incentive there is to maintain the status quo.
Yeah, that's a very powerful slide, that, actually, and it really just tells you what's going on. Interestingly, did you see that the LNG price in the US is a lot lower than internationally now? It's quite interesting, right? And that's partly because they've really ramped up their production in the US. They also had a bit of a problem with one of their liquefying systems to be able to put it offshore. So there's a big differential now between the US and other places. I think we're going to see more of that differentiation ahead, actually, on a number of fronts, and this is a good example that you've just shared with us.
Yeah, definitely. I mean, I think we're going to see, these sort of regional issues, these regional differences emerge as supply chains, as these economies become more regionalized, as they rely on things closer to home rather than on the other side of the world. And just on the point of the LNG cargoes, one of the things I think is really interesting is that China is signing forward LNG cargoes well into the next decade right now with both the US and Qatar and others. Yet, because Europe doesn't have the facilities yet to fully sort of more fully cover its gas needs going forward, it's not signing those contracts. So, it could end up in a really bad spot in that regard. Well, it's already in a really, really bad spot, but it could remain in a bad spot in that regard going into the future.
Yeah, and Germany, of course, is looking to get 4 mobile, effectively, degasifiers, or whatever the right word is, to be able to actually convert the liquid natural gas back into gas that they can then pipeline, right? The first will be delivered maybe by the end of the year. Right. Yeah. They've got 4 on order. And the other problem they've got in Europe is that some of the best degasification processing is down in Spain, but they've only got 2 relatively small pipes over the Pyrenees to get to the rest of Europe. So it's a mess.
Yeah, that basically sums it up. Okay, this is our last slide for today, and it is the global credit impulse. And it basically just shows how the global credit impulse is now lower than it was during the worst of the financial crisis. And this is from Macro Elf on Twitter, and that basically corporate earnings could, well and truly go along with it.
And it's a mess. Look, this is one of the most critical things for people to understand, right? The stock markets have not yet factored in the fall in earnings that we're going to see across multiple industries and multiple geographies, for all the reasons we've spoken about. But this is one of the critical ones, right? The credit impulse is just very, very weak, and that is going to have a significant negative pressure, in my mind at least, on stock market values over the next 6 to 12 months. So anybody who thinks that we've hit the bottom and now we're on the way up, I think is missing the point. This, as a forward-leading indicator of more trouble ahead, is very, very significant. Yeah,
it is. It's going to be quite interesting, because I think that this market is quite volatile. It's quite. I mean, it's almost a little bit bipolar. It just sort of flips between these different settings. But one thing it has been so far has been orderly. It's been relatively orderly. People have been buying dips. Things haven't blown up. There's been relatively consistent demand for things like treasuries. So there really isn't that fuel for intervention that there was back in 2020. So, people hoping that the money print is going to get switched back on relatively immediately are likely to be disappointed.
Well, I think the pitch you had earlier on of, running from one side of the ship to the other side of the ship is a perfect analogy for what's going on at the moment, right? So some days we think, everything's going to go up again and everything's fine, and the other days we think, hang on, more earnings losses and lower markets. So the markets are going side to side to side, but at the moment the ship's still managing to hold its position in the water, just tilting a bit sort of far over and then tilt, but it's not actually looking as though it's going to capsize. And that's the point, isn't it? Because if you can actually keep on doing that, you can go on lifting rates for quite a long time. And Powell has already said that, he's accepting that the markets will probably have to come back a bit, and even the housing sector will have to come back a bit. And here in Australia, well, the RBA says they're not responsible for house prices. APRA says the same thing, by the way. So you can't assume that just a fall in house prices, right, or a fall in the stock markets will be sufficient to stop them tackling the critical issue of getting inflation under control. In other words, rates are going to be higher than many people expect.
Well, exactly. As long as things remain orderly, and that's sort of been the theme of some of the charts for earlier. Like with New Zealand. Okay, the economy's come off a little bit. Obviously, that's going to happen. You've smashed all this. That you smashed all this extra cash into the economy. Like crazy. You've seen this massive run up in in spending. You've seen strong growth in GDP. Of course, that's going to pull back as you take it out. The froth is going to come off the top. But as long as the underlying fundamentals of the economy, like the labor market, remain okay, and the market doesn't tank because it's relatively it's relatively orderly. I mean, who knows where the bottom is then? There's no incentive for them to do anything. They just be going, oh my God, this is the most soft landing that we've ever done with the market. This is fantastic.
Yeah, absolutely. And it's interesting that the Bank of England this last week said we're going to have to do more, and probably significantly more, because the inflationary pressures are getting stronger and stronger. So there is no enthusiasm yet that I'm seeing for real easing back. We'll see. Maybe that'll change. But at the moment, with orderly control of most of the levers, it gives them a free rein. So we'll be watching this over the next few weeks, eh?
Oh, definitely, mate. There's way too much going on to look away.
Exactly. Well, it gives us always plenty to talk about on a Friday, and we've come way over time once again. But I appreciate your time today. Thanks for the charts, and we'll put the links and things below, and people can go and download those charts and look at them at their leisure from Substack. So that's great. Have a good weekend, and we'll do it all again in a couple of weeks' time.
Yeah, no worries, mate. I'm looking forward to it.
See you then. See ya. Bye.
Bye.